Thank you, Marty. I'm really pleased to be here. Your events were always amazing, and appreciate the ability to chat about venture today. I'm a third generation from California. I know there's not a lot of us left, but there's a lot of changes that have occurred here, especially on the venture side most recently. And I come from the investment banking side, financing debt, corporates, and governments in California, and have relationships also on the national level. And I'm just happy to be here. I left banking and invested in early stage, seed stage, Series A private transactions for my single family office. And from there, I have now created an opportunistic fund for investing in seed and Series A, because I believe the time is actually now with valuations and capital constraints.
Okay, so Tracy, I'm going to put Darcy on the hot seat, because we were going to call you, but I got home around midnight, which is a little bit too late. And when I got up at 6:30 for the markets, I thought it was a little too early. So we'll let you go through the topics as we talk about them. Why don't you give a little background prior to that?
Sure. Nice to meet everybody. I'm Darcy Coolican. I'm the founder of Scenes Capital. From Canada originally, and then ended up moving first to New York and now to California. I come at this from the kind of entrepreneurship side of it. I founded a company in 2023 that was a consumer fintech company. Then from 2018 to 2022, I was an investor at Andreessen Horowitz. Left and started Scenes Capital. We're a $15 million seed stage technology-focused venture fund based in SF. I'm focused on kind of companies and categories that sit in what I think of as the seams of an increasingly specialized venture capital ecosystem. So kind of core thesis is that the most interesting seed stage opportunities don't fit nicely into the like fintech, consumer, enterprise, crypto buckets that traditional funds have organized around. But yeah, traditional kind of seed stage venture capital fund.
Okay, Andrew, thanks for showing up. Otherwise, I'd be on the stage alone here. So why don't you give us a brief intro?
Yeah, of course. My office is just down the street, so it's easy. I'm Andrew. For the last 6 years, started along with two co-founders and built a now $2 billion multi-strategy venture capital fund. We have a $470 million early stage fund where we lead seed and Series A deals, and as well about a $460 million growth stage fund where we do everything Series B. And later, the core pillars of the firm are research and purpose, and everything on the investment side is really driven by our research process, which is highly trend driven, looking for the largest trends and subtrends that are automating the largest sectors of the real economy. Think sectors like healthcare, logistics, transportation, sales, etc.
Great. Well, I'm not sure I could follow up any better introduction than what Marty gave me, but Gary Sawka, I've been doing some of these for Marty for many years, and I guess he's been a very generous man to put up with a lot of the things I say, though they're all sincere. So I went undergraduate USC. We have one of the largest blogs for the USC Trojan football team. We've got USC, and then I went to Harvard Business School, also one of the most widely read class notes for one reason or another, perhaps some of the comments I've made. And then went to corporate venture capital, and then worked for many years for what later became a Sam Zell company in ITEL, moving up the ranks in transportation equipment leasing, started our own company in the same area, and then later on a few industries in Silicon Valley. I had a biotech company, distribution company, a couple of semiconductor companies. So we've kind of been, all over the place, and most recently been board members, CAI International, which is in one market. I was there for the entire 14-year life public company, and now is in much smaller, kind of private equity funded companies. So, it was fortunate we had both with Tracy and Andrew, we went over some of the topics, and if you listen to yesterday, some of the topics we'll cover today go and are widespread over everything. But we thought about three main topics, but now I've actually thought of another one while we were, driving in here. The first one is really, and it's the regulatory environment, and we see that in terms of lots of stuff, and in the drug industry, that there's a lot of pressure, in the Inflation Reduction Act for the government to talk about, fixing prices for the Medicare. But there's also a lot of antitrust activity in the government among lots of different companies. And so I think what happens will take off on, and of course there's, regulatory in some senses taxes, because taxes follow a lot of the regulations of how they want people to act, depending on whether they invest in a specific, a preferred investment, or just try to, try and structure your taxes such like corporate, whether you're going to stay in the United States or not. So I think we'll go ahead. I'm actually going to let Andrew talk first, because he actually is here in person. So, and then I'll go ahead and talk to Darcy and Tracy. We'll go one round, and then we'll just, let everybody chime in as they go on. So maybe a couple minutes overview on that topic.
Sure. I think venture has a lot less run-ins with regulatory bodies than other asset classes. I think you have you have the SEC as the main regulatory body that we deal with on a regular basis. What's unique in venture capital is you can be an exempt registered advisor, which means you don't actually have to make any filings with the SEC other than Form Ds and Form ADVs. So we don't actually think about regulation on a day-to-day basis. I think if you are a registered investment advisor, which there's many in venture capital, then it is a little different. I think on the antitrust side, we believe that the FTC has been somewhat weaponized from a political standpoint recently, and has made a lot of posturing around blocking certain mergers and acquisitions, which have been announced also internationally as well, like Microsoft's acquisition of Activision just went through after like 2 years of threats that it was going to be blocked. We're shareholders in a company called Figma, which but over a year ago now entered into an agreement to be acquired by Adobe for $20 billion, which would make it, I believe, the largest ever venture M&A exit of all time, beating WhatsApp, which I believe was the previous largest. And that has been under regulatory review for over a year now. And after talking to many folks at the company, our feeling is that they will sue to block it, mainly because the government, especially under the current administration, wants to make it seem to the public like they are anti, big tech and consolidation. But our belief is that they won't actually win that. It'll go to trial, and I think the data will say that it's not actually going to decrease competition in the market. But yeah, those are my
okay. So that's some good stuff. So let me go ahead to Darcy. Why don't you chime in for a couple minutes on that topic of all things, including taxation or corporate tax rate, or carried interest, whatever you think is important on your mind.
Yeah, I mean, I think to Andrew's point, I don't think regulatory is is something that at least I personally think a lot about just in the day-to-day operations of kind of like a venture capital fund. I think, fortunately we are somewhat somewhat separated from some of the more kind of arcane regulatory pressures. I do think it's something we think about from a investing perspective. Seed stage investing is obviously we're looking for things 10 years out, so it's hard to orient too much around the current regulatory environment. But there are categories where the regulatory environment becomes much more significant. Healthcare is not a category that I actively invest in, but that's obviously one where it's very important. I think the two that I invest in that I'm seeing much more kind of questions about are, one is on the crypto side of it, where obviously there's a bunch of things going on now, and people are trying to work through the regulatory process there. And hopefully we'll have more clarity in the next kind of 6 to 12 months on that. And that's a little bit in the kind of like later stages of their kind of regulatory journey. And then the other one that we see right now is AI, which is, again, I'd say it's very nascent in kind of where it sits in the regulatory world, but lots of kind of questions being raised and a little bit of uncertainty in terms of what that will look like going forward. But, I think, generally I tend to try to focus on kind of like exciting technologies and exciting markets, and it's very hard to predict kind of where the regulatory landscape will play out in terms of the categories that we're investing in.
Okay, Tracy, why don't you go ahead? We've already talked about this among ourselves, so you've got a lot to say on that.
Being a third generation from California, I come from a family of entrepreneurs. And so the landscape has changed so drastically in California, and the regulation and regulatory environment has been substantial in all industries. I think the biggest threat to entrepreneurs in general on the venture side, just entrepreneurs, is the regulatory environment we live in now. And especially in California, I think the regulatory environment has changed so dramatically. It used to be you can come to California or anywhere and you can create businesses and you can flourish. That is not the case anymore. And it's I'm just making a general statement. I'm not going into details from the federal level or the state level, and I can cite, example after example, but seeing the regulatory environment, that is the biggest threat to innovation. It is the biggest threat to entrepreneurship across the board, and our universities are able to turn out exceptional talent because we had a lot of flexibility with regards to the regulatory environment, and that has changed a lot, not only recently with the banking issue, but just across the board in the last 10 years. It has changed so much on the entrepreneur side, and entrepreneurs are the ones that create this incredible technology, that build these incredible businesses, that create jobs across the board. So my feeling is that in order for us to be innovative in the states, we have to start looking at how overregulation is affecting entrepreneurs and businesses, even on the venture side.
Okay, any question on that subject?
I just had a follow-up. Tracy, can you hear me? Okay. Yeah.
Yes.
So my follow-up is, have you guys given any thought to ESG, in particular the governance layer, and the impact on entrepreneurialism? Because it seems to me that a lot of this governance could really put layers of restrictions on entrepreneurialism that haven't been thought of in the past, right? Because it seems like, I would think entrepreneurs just need a clean road with as little interference as possible. Any thoughts on that?
Yes, I mean, I think there's a couple of camps here. There's the impact camp, which I'm part of the impact camp. I mean, you obviously want to increase participation across the board in companies, even entrepreneurial related companies, with regards to impact. But you also don't want to have greenwashing. So you want to have a balance of what you're doing on the ESG side. And it's really finding taking out the buzzwords and finding entities, corporations, entrepreneurs that are really, spending their time creating and solving the impact issue. You talked about John Molina with regards to ESG investing. He's actually doing some incredible things with the ocean, with the sea layer, and the things that he is doing. It's not affecting his business. He's just increasing impact. And I think there's more of that, and taking out the buzzwords and the people that are using the buzzwords in order to build their business around the buzzword, but are not impacting. And I think there's definitely a different group that are doing both. And it's really important to separate out who's doing what.
Yeah, I didn't want to focus on impact. I wanted to focus just on governance.
Oh, okay. Sorry. On the governance side, no, I think there's a balance. I think California has led this way with regards to the balance of diverse or female founders with regards to C-suites. I think that's across the nation now, and I think it's a good thing so long as you stay within exceptional founders. I think first and foremost, investors want a return on their investment. And so making sure you have exceptional founders across the board and having a balance of exceptional founders on governance is important.
Maybe the others can give their opinion.
Female and diverse founders as well, underrepresented as well.
Darcy, your thoughts?
I'm not sure I have anything anything more particular to add beyond what Tracy said. I mean, yeah, I think it's I think there's always a kind of like tension here, and kind of smart, being smart is the most important piece, and being, you know, not overly prescriptive, and kind of like letting the markets play out as they need to, while also kind of encouraging things and nudging things in the right direction.
If I could just make one point, I mean, I think 1.9% of venture investing is invested in female founders, and there's exceptional female founders across the board. So I think there has to be a balance, and there just has to be investment in exceptional founders, and it would be great to have it across the board as well.
Yeah, I'm not even talking about DEI. I just want to ignore the, I mean, I'm Hispanic, right? I don't want to ignore the DEI part and just really focus on other aspects of governance, which might just be a bridge too far for small companies. That's all.
I think it is. I think the over-regulations that has happened here is a bridge too far for small companies, even outside of venture. It's just so substantial, the documentation and paperwork, and people showing up at their offices asking them for, you know, regulatory sign-off on small businesses. I think it is a bridge too far. I think that,
yeah, I mean, a lot of entrepreneurs, they go to engineering school to design great things, not to fill out paperwork. So
exactly. And it's unfortunately, a lot of our elected officials have not employed anyone in their space. They've been elected. We have a couple doctors and lawyers, but I think it's like the number is 97% of our elected officials has not employed one person. So the perspective has to really shift. So people understand that you can't overtax, overregulate businesses. From a perspective, these are small businesses. They don't have time to fill out all this paperwork. So I agree, Marty.
Okay, well, let's see. We got enough on that topic. Let's move on to the next topic, and that's the market environment, and mostly in terms of interest rates and business conditions and stuff. And, you know, yesterday when I got up in the morning, the first article on Bloomberg was one that said that most of the smartest guys in the world, in terms of the hedge funds and others, didn't think the interest rates were ever going to go up. Maybe they're listening too much to the administration, and that they hadn't hedged the interest rates. And so now they're, you know, many of the real estate loans are going to start coming due in mass in 2024 and 25. And so just as an example, there was a time when interest rates were real low, and I'm going to just use this as a quick example. At CAI, where I was the board member, we were offered a swap on the $500 million revolving credit agreement we had for 20 basis points. So 20 basis points on $500 million, what is $1 million? So what happens is that it was like LIBOR plus 20. So the most we could lose if LIBOR got to zero was we could lose, you know, $1 million a year. But when we got up to 5% interest rates, they were making $25 million. Now, one of the systemically important banks wrote that. I don't know what happened to that, that maybe they traded around it or whatever, but we were getting a lot of money. So there was such a good deal in swaps, yet what stuns me is how much people didn't take advantage of it. And then you look, on the other hand, some pretty smart guys like Google and others took 10-year notes, which they were issuing at 1%, which, you know, was big yield because the government was issuing at like 0.5% or so, and those bonds trading at 50 or 60 cents on a dollar. So those guys could, in fact, buy them back at half price. And so this is my only political statement here. There was the former president said, you know, why don't we issue 100-year bonds? Well, had we issued 100-year bonds at like 1% interest rate, we probably could have bought them back at 20 cents on a dollar, right? And you wouldn't have had a debt limit problem because, you know, you could buy them back and then issue a whole bunch more. They could have actually avoided the debt limit for a long time. But anyways, that was it. There's a lot of stuff there. So the question is, in today's environment, especially with the interest rates, is a big barrier. And a lot of people still pining for lower interest rates and still having pretty high levels of earnings growth that they expect, and not just from the hype of the top 10 guys. Do you see all of that in guys that have big portfolios like real estate now going to be impacting the valuations and also the ability to get funds for the VCs? And in which way do you think you're going to act to look at that? Go ahead.
I think about interest rates less in terms of how much it costs venture-backed companies to borrow. I think the amount of capital that venture-backed companies get through the debt capital markets is like pennies compared to what they finance via venture capital in the equity capital markets. I think the biggest impact, certainly for venture capital, has been the rise in valuation multiples from a zero interest rate environment, particularly combined with what happened during the pandemic. And now with rates where they are, you see multiples have come back down to historical norms and are actually lower than they have been in like the last 4 or 5 years before COVID. So really our business is impacted by interest rates in terms of interest rates impact on valuation multiples. And for tech in particular, when so much of your present value is driven by cash flows far out into the future, it has had a drastically negative impact on what those businesses are worth, which has caused all sorts of problems for people's portfolios. And it's why you saw Tiger Global trying to raise a $10 billion fund and ended up raising a $2.7 billion fund. So that's where interest rates have seriously impacted tech.
What about the bank pullback?
Again, it's a nuisance, but it's really not that big of a problem. SVB and FRB were quite important for venture capital over the last 10 to 15 years. And in particular, people talk about like technology and automation. I don't know if anyone's tried to open a bank account in the last year. It's still very, very difficult. You have to sign, you have to hand sign things. You have to go into branches. It's actually still really not easy to open bank accounts with a traditional bank. And so JP Morgan, who bought FRB, for example, is notoriously difficult to work with in terms of opening bank accounts. And FRB and SVB would allow companies and funds to open bank accounts quite easily, get capital lines of credit, issue wires, et cetera. And so it's just kind of, for the CFOs and VPs of finance, I think it makes their lives a little more difficult. Where you'll really see the impact, I think, is on two areas. SVB and FRB were giving loans against privately held stock. So if you were an early employee at Instacart or Databricks, or a company that's now worth over 10 billion plus in the private markets, and you had stock that was worth 20 million, you could go get a loan for 10 million against that, which is great because then you're not selling that stock, you're not paying capital gains, right? It's efficient from a tax perspective. And SVB and FRB were really the only ones doing that. So that financing is going to go to the market, which obviously will impact many things. And then similarly, GP capital call lines of credit, which when you raise a fund, and if you raise $100 million fund, usually you have a GP commitment, which is between 2 and 5% of that fund. So if you're a GP and you're raising that money, you have to fund $2 to $5 million yourselves. And there's a significant amount of GPs, especially emerging managers, that actually don't have access to that liquidity. Often it's tied up in stock of private companies. And so what SVB and FRB would do is they would write lines of credit for those GPs. And those lines of credit would be securitized against usually the management companies for the funds or even the GPs in some scenarios. And I expect that to decrease significantly. And I think the impact will be, you'll see for emerging managers who start their own funds, I think you will see them raise smaller funds because it will be harder for them to fund larger GP capital commitments. So those are the two biggest impacts, which will drain kind of liquidity out of the system.
Yeah, and so during the congressional hearings on the collapse of both of those banks, J.D. Vance, who intimately involved in it, talked about all those issues, including, you could get a loan on your winery or vineyard in Napa or your jet or whatever. But what was the most surprising thing is that even though you had to keep all this cash in the bank, there was no restrictions on withdrawing it. It wasn't like it was a blocked account or a restricted account. So in almost instantaneously, you found that. And I converted most of my stuff to First Republic Bank. And it was a situation where they're a lot better, though I also have 2 accounts still at Chase. So now I'm going to have 4 accounts at Chase. And so what happens is I'm going by that day after Silicon Valley Bank, and I go by San Antonio Road in Los Altos, and I says, God, there's a lot of people in line for the pancake house. There's a really nice pancake house there. And then finally, I said, not going to the pancake house. Even have these Dutch baby pancakes, really good. It's all the people going there, and pretty, a lot of these guys had, this was like, all Mercedes, Tesla, reunion there, because they were just there, a few McCarrans, but so they're just taking all their money out instantly. They're just going there. They didn't even trust I guess they were just carrying it out in cash or, asking for a wire transfer. So it was like that. And it really was so quick. And that is really hot money, isn't it? That's really hot money. Darcy, any further comments on that particular one? And will it just cut down the valuations just because of that? Because I know Tracy's going to follow up with the final comment on how much of the ecosystem is related to that and what the valuations will happen.
Yeah, I mean, I think it's obviously going to be much more challenging times for people trying to raise new funds, new venture capital funds, just given the interest rate environment. That said, there was a lot of capital raised in 2020 and 2021. And so I think a lot of managers will just be slower to deploy. So I do think there will be still kind of a significant amount of capital in the system. I think people will just be slower to deploy because, instead of raising a new fund in 2024, they're now thinking they'll be raising in 2025 or 2026. So, there is still lots of capital in the venture capital ecosystem. I think it's just going to be slower to deploy. That said, I do think there's actually like a lot of opportunity in the ecosystem right now, both on the fund side and on the company side. Obviously, we've seen valuations dropping, and there's lots of valuation pressure, lots of downward valuation pressure. But I think the other thing that's happened is that because founders and entrepreneurs don't know exactly when they're going to be able to raise their next round or exactly the milestones they're going to need to hit, they're much more focused on profitability. They're much more focused on margins over just pure growth. And so I think ultimately that will lead to a really, really strong vintage, particularly on the early stage venture side, in terms of the companies that are born in this cycle, and then obviously the funds that are lucky enough to invest in them.
Okay, Tracy, you had a pretty good opinion on the SVB and FRB. So why don't you go ahead and start on that and elaborate?
Well, in general, I think in speaking about this day and age, I think there's a huge opportunity right now. We're raising an opportunistic fund in the financial technology area because of that fresh capital now raised to be able to go and negotiate and invest in maybe a Series A that really is a Series B, pricing it in the valuation in that range. I think there's a huge opportunity. That opportunity won't be here forever. So there is a window for that. And I agree with both of the panelists. I think that Silicon Valley Bank and FRB really created an ecosystem out here for the ease of venture capital was able to grow and expand. And it really created an acceleration of valuation, an acceleration of the ability to interact in this space. That is all changing. And I think because of that, the ecosystem in California is also changing and going to other states as well. I think the ability to scale companies is still here. The ability to have exceptional founders, the ability to invest right now with fresh capital, I think is a really great opportunity if you have the means, if you've raised a fund, if you have the ability to raise a fund right now to invest with these type of founders. I also agree that there's a focus. I've talked to a number of founders that their whole focus is just decreasing burn rate and getting to profitability, and whatever they need in order to do that, to raise their next round in 24 or 25, that's what their focus is. And I think that went a little bit by the wayside in the last several years because of this issue of, the acceleration of valuation. So there's exceptional businesses right now that are working towards profitability that maybe they would have taken a little longer in another day and time.
Okay, so, and yesterday we had a pretty good panel on real estate evaluation, and it seemed like everybody, and maybe this is the same for the venture capital, think that any recession, if we ever have a recession or a slowdown, is going to be extremely mild and not long lasting. So I may be, and I guess Marty too, be some of the few people who've actually seen some pretty long recessions, and they went on for a long time. And we had, when we had well, I don't want to date myself, but 70s. Yeah, 70s. Yeah, the 70s, and during Ronald Reagan times, I bought a house there, and I had to, assume all the loans, which you could, but when I took out a variable loan at that time, it was like 11.25%, and 16.25 was the cap rate, but there was a bottom of 6.25, and I says, you don't have to worry about that, and they will never have interest rates below 6.25, but we were lucky because it did hit, it bounced back again to 16.25. So, there is some bounce backs there, and there's been a lot. So do you think, and I'll just throw this out to anybody who thinks they got a good answer for it, do you think the expectations, the fact that unless you're in the, I don't want to call us senior citizens, but those that are a little bit older than, 30s or so, or 40s, do you think there's an expectation that everything is sort of happy times, that, we had the debt crises, but all of a sudden everything's cool again, and, we go back to good times, and that they can't even mentally think about economics going on for maybe a recession going down, and the GDP going down, more than, kind of a fraction of a percent. Do you think that environment hurts the thing, or do you think you guys are astute enough that you're on the valuation edge?
I'll just make a quick point. I think all these issues are going to be regionally focused too. I think that's important. One of the things that's going on in California that people are not aware of is that our insurance companies are leaving here. How does that affect venture? How does that affect people that live here? Their ability to get homeowners insurance, renters insurance, multifamily insurance is impacted. And so it definitely affects the ability to invest in real estate. And so I think from that standpoint, I think it's going to be regionally focused as far as venture investing, and as far as how rates and environmental issues with regards to these kind of issues are going to impact investors.
Tracy, what are good regions from your point of view?
Well, obviously, Texas is still great. I mean, we're looking at Texas and obviously Florida still, Tennessee, there's a lot of different states that are great. California is still great. You just have to be very aware of what's going on in the regulatory environment. Our ability, as I mentioned, to turn out exceptional founders out of our schools and universities has been #1 in the country, and that is still continuing it. It's just whether they stay in California and can afford to stay in California. And so there are exceptional technologists here that grow businesses very quickly because they're on their second, third businesses. And so it's really just looking at the opportunity of the type of investment you're making and the region of which is impacted, whether it's financial technology, whether it's healthcare. It depends on what region you're in.
Anybody else for comments?
Sure. I mean, I think there's been at least, you know, my N of one, and I'm not a macroeconomist by any means, but, you know, just kind of seeing how the market has played out, I think there has been a bit of a bifurcation on both the venture investor side and on the kind of founder entrepreneur side, where, you know, one group, you know, thinks it's just a matter of months before the party's going to start again, and another group has been very, you know, being very, very conservative in terms of figuring out how to get to profitability, in terms of figuring out how to become a company that's default alive and doesn't need to rely on capital markets specifically. You know, TBD, which one will be the right strategy? As I say, I'm not a macroeconomist, so I don't know what the exact right strategy is, but, you know, I do think there has been a bifurcation in terms of some folks thinking that this is a temporary blip, and some folks thinking that it is, you know, it's a little bit more systemic, and we're in for, you know, years and years of more pain.
Yeah, there was a great, in terms of, did you have a comment?
Yeah, I just want to get back to what Darcy was talking about. I'm not sure if things are going to be bad for long or short, but I'm wondering if it's just a matter of entrepreneurs have to get back to fundamentals and not be as grand. Right. I mean, in other words, and maybe you have some thoughts on that. In other words, lots of great companies were created with little capital in the past, or little venture capital, and then they were still great, right?
Mm-hmm.
So,
yeah, I mean, I think it's a little bit of a strategic decision on the founder standpoint. I think, you know, for the last 10 years, we've been in an era where capital was relatively cheap, and you know, venture capital specifically was easier to raise than I think it will be going forward. And so I think from a strategic perspective, you know, there's different ways to operate a company, and obviously they're existing in whatever the financing environment is. So, you know, I do think amazing companies can and will be built with much less capital available to them. And I think that's probably like a good thing for the system over the next few years. But, you know, that said, it very is much a strategic decision on the side of the founders, and you know, I think in some cases raising more capital has been advantageous over the last 10 years, and we'll see what the right strategy is going forward.
I mean,
Okay, let's go ahead.
I just want to make a quick point. I'm pretty bullish on some sectors in venture. I do believe that the acceleration is going to happen very quickly. And, you know, what you're going to see in venture, I mean, specifically in cybersecurity, AI, there's a number of them, and that acceleration is still here and still going to happen. And so the opportunity to invest now in those types of entities at lower valuations is really attractive across the board. And it's just finding exceptional founders that can scale in different economic times.
Okay. All right, so we'll go on to our third topic, and that is really risk mitigation, although we've actually brought that out a bit. How do you guys, in this environment that may be tougher in terms of growth and valuations, how are you going to mitigate your risk in terms of folk, and Tracy, you know, sort of gave me the introduction on that in terms of looking at experienced management teams and high growth areas. But Andrew, we talked about a bit of that on our pre-call, but you have some comments on that in terms of how you're going to risk mitigate some of your things, because you do your own research there, so you don't, you know, get deals given to you. You look for deals.
Well, the venture as an asset class is, you know, as risky as it comes, and, you know, generally it's obviously different by which stage of company you're investing in, but at the seed Series A stage, so our early stage funds, you know, if there's 30 companies in them, 10 which we led Series A's, 20 which we led Series C's, realistically 3 to 4 of those companies will generate 90% of the return for that fund. And it could be even less than that. It could be one company generating 90% of the returns for the fund. There's massive power laws in venture capital. And so, you know, I think risk mitigation at the early stage is interesting conversation. We are trying to back, at least at the early stage, exceptional founders who are building businesses in trends that we believe are going to grow much faster than the average trend over the next 10 to 20 years, and where there's opportunity, the market will be able to accommodate multiple billion-dollar exits. And so when we find a trend like that we have high conviction in, and then we find an exceptional founding team, like that's generally where we tend to lean in. On the growth side, again, we're focused on investing in trends that we've done a lot of work in, that we have high conviction in. And then we're looking for companies that have been capital efficient. Generally, if you find a business that has gotten to 20 or 30 million of ARR, and it's only spent 10 to 15 million to get there, generally there's something going well there, and there is 30 to 40 years of data showing that capital efficient bootstrap businesses generally lead to better outcomes than those that have spent inefficiently. So I think that's how we think about getting an asymmetric risk return profile. But yeah, I think there's not much that obviously in venture, you can add structured rounds, particularly at later stage. You can put in participating preferred, you can put in higher liquidation preferences, et cetera, but we don't really do that. It's more private equity firm focused.
Okay, well, that's a good
I have a
thing.
quick question. So Andrew, just getting back to the point you made. So do you think that since interest rates are higher, things are slowing down in the investment horizon, that and with less FOMO, that I'm not talking about you because you guys have been incredibly successful. I'm talking about your VC peers. Maybe they'll also get back to fundamentals as well, because of the reduction in FOMO.
Well, I think the key thing from our point of view that has changed over the last 2 years is, and this is an effective interest rates being at zero and it being easy for capital raise companies, and then interest rates going up, multiples coming down. That used to be from 2020 to 2021, you could find a company that got to 10 million of ARR and had burned $30 to $40 million to get there, but it was in a good trend and maybe the founders were flashy, and that company would not have a problem raising capital. That company cannot raise capital today. If you are a founder and you have been inefficient to get where you are now, there's some differences. Like you can look at OpenAI, right, which had to spend a ton of money because they were solving primarily a technological problem. They had an innovator's dilemma, right? And they spent a lot of money and it worked out well for them. That is very much the exception. But now really any company, particularly in software, you just happen to be capital efficient. And you're not going to see us or our venture peers, I think, in this market fund businesses that have been inefficient from a capital perspective.
Well, that's a great comment, Darcy, and go ahead and then we'll finalize it with Tracy.
Yeah, I mean, I think largely I agree with Andrew's perspective that, the job of an early stage venture capitalist is to find generational founders building generational companies. And that job doesn't really change in different environments. Like, given the power laws, that you're looking for your kind of, 2 to 3 companies that can change the world, and that job still stays mostly the same. I think that, you're given the uncertainty in the environment, what defines a generational founder might shift a little bit. You're looking for people that can be that can excel both in capital constrained environments and non-capital constrained environments. So looking for people that can be more flexible in terms of how they can manage their business, just given we don't know what the next 5 years is going to look like. And then the only other thing I would say is that, I think, to the question of kind of like FOMO and kind of where the venture capital industry is heading, I do think this tends to break down on a very category specific level. If you are somebody that is looking at the creator economy or crypto or vertical SaaS or something that's particularly out of favor, I do think founders that have been inefficient in the past, or founders or companies that are not particularly cash efficient, will struggle to raise. That said, I do think there's categories like AI right now where that may be less true, just given there's maybe still a little bit more of that kind of residual FOMO in that category. So I do think a lot of categories are getting back to fundamentals, but I also think that there's some where people see generational technology shifts happening where that may be less true in those categories at the moment.
Okay,
I'm just
go
going
ahead,
to
Tracy.
by saying I agree with both Andrew and Darcy. I mean, I think we've hit this topic. I mean, it's really risk mitigation, it's opportunity, it's a different market, it's finding exceptional founders, and it really is looking at how they have conducted their businesses in the past and whether they've just been, focused on a decreasing burn rate and really getting to profitability in a period of time versus all this easy money that came to them. So it definitely affects the future going forward for all those entrepreneurs.
Okay, so here we are with a really good group of people that showed up early in the morning to hear this presentation. Why don't we take a couple of questions, if there are any from the audience, before we sign off and turn it over to the next panel. Anybody here? Okay, so talk a little louder, unless you want to.
I'll talk louder.
Okay.
Just to ask all panelists, what's the best strategy for VCs?
What's the strategy to deal with the reduction in banking? I think we kind of addressed that earlier, but are there any other points to it?
It was almost, there's two different points to that. In terms of just banking with the funds, it was a non-event. Like, we moved our funds over in 12 hours, and our LPs didn't really notice a difference. We didn't notice a difference. I think where you will see it is as it slowly trickles through the system, and it's just going to make it harder for certain people to get liquidity, like when it comes to GP capital call lines of credit or getting loans against private stock. But just in terms of day-to-day from a VC fund perspective, it really was, despite causing an immense amount of stress, it was really a non-event.
Well, some of the banks, I think, are trying to get. But do you foresee there are more banks?
Yeah, I think it'll be cyclical. I think you will see, I think that's why JP Morgan wanted to buy FRB, because they would never really have been present within the VC ecosystem. And they also probably wanted FRB's client base. But yeah, I think so. I mean, I think that will be a positive.
Yep.
Talk more about some of the trends you see as big ones right now, and what why you have the conviction in them.
I'm happy to talk unless one of you would like to.
Questions of
Yeah,
I didn't
basically
hear the
big
question.
trends you might see in the that you guys see today, besides the ones you've already talked about.
In the venture capital ecosystem, or more in the kind of technology entrepreneurship ecosystem?
Yeah. So from an investment thesis standpoint, like what are the big trends you see as creating investment opportunities in the venture capital?
Yeah, I mean, I'm happy to talk through kind of our thesis, which I think is a little bit on point here. Kind of my thesis is basically there's been an increasing specialization in venture capital over the last 5 to 10 years. Basically, you went from funds that were largely generalist funds to funds that are crypto specific, enterprise specific, consumer specific, vertical SaaS specific, et cetera, et cetera. My thesis is that the most interesting companies, particularly in the early stage, don't generally fall into these buckets. And so I tend to look at trends before they kind of have names or have categories. Again, I'm a seed stage fund, so this would be different from what Andrew's doing at the kind of like A stage round or growth stage. We spend a lot of time around kind of solopreneur tools. We spend a lot of time around pseudonymity. We spend a lot of time around kind of jobs and vertical hiring marketplaces. But I just think that, for me, the largest trends are, categories that where there's lots of founder interest that now don't have proper coverage in this kind of increasingly specialized venture capital ecosystem.
Real quickly, I do think that financial technology, even as Darcy was talking about around the seams, is still going to be a priority in the marketplace. 1/5 of all of transactions, seed Series A, come from, or 20% or so come from financial technology and financial technology in healthcare. So I don't think that is going away. I think that's continuing even outside of the other areas that are growing as well. And I think that